Welcome back to CEO Money. I'm Michael Yorba.
I'm Vince Rowe.
And Vince Rowe doing the show.
Yeah, I'm getting it.
Yeah, you're catching on. All right, we've got Phil Aguirre, founder, Prepared Capital, preparedcapital.com. Phil, welcome to the show. Thanks for being here.
Michael, thanks for having me on.
My pleasure. All right, you've got about at least 10 years under your belt at Morgan Stanley. Give us a better, well-rounded view of yourself, and then Vince has got a million questions for you.
That sounds good. Yeah, I started with, it was Smith Barney, Citi Smith Barney before the financial crisis, right at the end of 2007. So I had probably the worst timing as far as getting into financial services. And then, going through the financial crisis, Smith Barney was acquired by Morgan Stanley, and I wrote up the 10 years of my time there with Morgan Stanley, which I parlayed into a very successful career. But during that time, I was always kind of concerned, looking over my shoulder, given the fallout of the 2008 financial crisis. If we went through another one, I was really worried, if I was still going to have a job. Most of the people that I worked with, unfortunately, were laid off or demoted in some way, shape, or form, just as the companies tried to, adjust to the new, the new environment post-crisis. So I started doing some research on business cycles and recessions and what causes them. And what I found through my research is that every business cycle has the same characteristics as we get towards the end of a business cycle. So I did years of research on this and developed a research process, which I call our business cycle indicator, that predicts downturns in the economy or recessions. So this research goes all the way back to 1968, is as far back as the data is available to formulate the indicator. And during that time, there were 7 recessions in the United States.
I was going to ask.
And this algorithm, our business cycle indicator, would have predicted all 7 with the average lead time of about 13 months.
What were the key factors in the algorithm that you saw consistent across every single recession?
So, admittedly, Vince, we don't share all of them because it's certainly confidential information. But I'll give you one that's really simple and that everybody can understand. Mm-hmm. So every Thursday, the Department of Labor announces the number of people who filed for unemployment insurance the previous week. So every week you get a report that comes out. Right now we're hovering just over 200,000 people per week are filing for unemployment insurance. It's a very boring number. It's not anything exciting. You're not going to see much about it on the major business news or whatnot. But what's important is how that number is trending over time. So naturally, if the number of people that are filing for unemployment is rising steadily, that is one indication that that a recession is more likely. That's a simple component that most people can understand. But some of the other components get a little more complex. That probably 10 minutes here, we probably don't have the time to go into all those, but that gives you a little sense of it, Vince.
Just as an interesting piece of that, one of the variables in the algorithm, is it always fraught with some level of corruption or some corrupt piece of the financial market that is always a contributing factor?
No, it's so I wouldn't say there's any. When you say corruption, you mean
let's not say corruption. Let's just say like we had the last one, the credit mortgage obligations, and prior to that there was housing, and there's always seems to be something that a financial institution or something that was one of the underlying drivers. Sure,
and so in every cycle there is a sector or subsector of the economy that is sort of the poster child for that recession. Like you mentioned, it was housing in 2008. Then that rolled into mortgage-backed securities and everything else. Prior to that, the previous cycle, you could say, was the dot-com bubble and the leveraged buyouts that would happen. Yeah, in 2000, right? Mm-hmm. So what our research does, it looks at the underlying drivers of the economy, which is mainly the flow of credit, right? How credit is being distributed through the economy. what we see as the housing bubble or the dot-com bubble, those are really just characteristics of that cycle. Our research kind of looks at more of the underlying trends within the economy. Most people just see it how it manifests in asset prices. There's really another level below that really drives the economy. As I mentioned, it's a lot of it has to do with the flow of credit. Employment obviously is a big one because we do look at, as I mentioned, the unemployment claims. So there's not a one component that is a common bad actor in every business cycle. It's different every time, but I would say that there's an underlying trend or consistent, tea leaves, so to speak, that reoccur at the end of every business cycle, and that's what our research tracks.
Vince has got a question, but I want to throw one in real quick, and I know you want to bring this out. Cycle-wise portfolios, process, performance. Yeah.
So the research that we put together, in and of itself, it's a very powerful piece of information, but it's not by itself. It makes for great conversation like this, but what we decided to do is take this information and build it into a investment discipline. So we started playing around with different methodologies for how you could put this into a actionable investment that people can participate in. And so that's where our cycle-wise portfolios come about. There's 5 different portfolios ranging from aggressive to conservative, and there's several in between. Invests in broad market ETFs, so Russell series of index ETFs. But the allocation in the portfolios changes depending on whether or not our business cycle indicator is warning of a recession. Naturally, as we go into a recession, stocks tend to do poorly through a recession, whereas bonds tend to do better. So the allocation within our portfolios is dependent upon the status of our business cycle indicator. So these portfolios can go back to 1995, as far back as you could test the portfolios, and naturally, if you can avoid the 2008 financial crisis, if you could avoid the dot-com bubble bursting, the net results are far better than the broad market.
We got to end it there, Phil. Thanks for being a guest.
All right, thanks, Mike. I appreciate it.
Thanks.
All right, you've been listening to Phil Aguirre, founder of Prepared Capital, preparedcapital.com. Vince Rowe.
Thanks, Michael.
You're welcome. And Michael Yorba on CEO Money. Thanks for listening.